In the investing section, we're going to look at the changes in my non-current assets. And the main thing we're going to see here is my property, plant, and equipment. Let's think about, for example, building. What makes the building account go up? When I do what? When I buy more building, right? If I buy more building, what happens to cash? It goes down or out, so I'm going to subtract them. What would make my building account go down? Not depreciation, though. Because depreciation does what? It doesn't make the building go down. Depreciation expense makes my accumulated depreciation go up. It doesn't make building go down. Building would go down whenever I sell my building, in which case cash is going to come in, and I would add that. So when we see something like property, plant, and equipment go down, that means we sold it, cash comes in, we're going to add it. When we see the property, plant, and equipment item go up, that means that we must have bought more. When we buy more, cash goes out, and we're going to subtract it then. So as we look at these, try to think logically about why are we adding or subtracting, because it really does make good sense then. Now, the way I do these, and you don't have to do it this way, okay, but this is my little trick, and I think it works well, but it's up to you. I think in terms of journal entries, and hopefully by now you've kind of gotten to the point with accounting, you're thinking in terms of journal entries also. So here's the way that I do it. Number one, I'm going to record the change in the asset using the normal debit credit rules. In other words, if I have more building, building is an asset goes up with a debit. So I would debit building in my journal entry. Then I'm going to record any related accounts. Okay, that could be something like notes payable, or it could be accumulated depreciation if I sold the item, or it could be a gain or loss on sale also. And step 3 says, whatever it takes to make it balance, plug it to cash. If you've sold an item, you should find yourself plugging a debit to cash because cash comes in. If you have bought an item, you should find yourself plugging a credit to cash because cash goes out. The whole reason we're doing this, and first off, let me say I call this a mock journal entry. We are at the end of the year. All of our transactions have already been recorded on our books. We are now going in, and all we have in front of us are the year-end financial statements and the previous year's financial statements. And so we're now trying to work backwards to see what must have already happened. So just by comparing the financial statements, I'm trying to figure out the journal entry that basically is already on my books. So understand that when I call it a mock journal entry, this is not something I'm actually going to put on my books right now. But instead, this is my way of figuring up what must have already transpired here. It is a tool to help us come up with what we need for the statement of cash flows. We're going to do some examples here. First off, I'm going to let David Jones have a razor company. David Jones Razors, their furniture account began at $15,000 and ended at $20,000. So last year we had $15,000 at the end of the year. This year we have $20,000 at the end of the year. What must have happened to make my furniture account go up? I must have bought more furniture. And I've got a place for you just to write there. Because again, we need to think about the transactions that underlie these numbers we're looking at. I'm going to do a pretend journal entry. Now, honestly, this one's so simple you don't need it, but just humor me because I want you to see the process. During the period, the furniture account did what? It went up by $5,000. What type of an account is furniture? It's an asset. More of it says it goes up. How do you make an asset go up? With a debit. Good. So in my mock or pretend journal entry, I'm going to debit furniture. There is nothing else to take into consideration with this entry. So we'll skip to step 2. There really is nothing. Step 3 says plug cash. To make that entry balance, I need to credit cash for how much? $5,000. So how much cash did I pay to buy furniture? $5,000. Now remember, what I put a box around, that's the whole reason we made this entry, was to figure out that number. Could you have done this one without a journal entry? Yes. And that would be fine. Okay? I'm not going to say do the journal entry. I'm just going to ask you for the numbers itself. We obviously paid $5,000 cash to buy furniture. What section of the statement of cash flows is that going to go in? Operating, investing, or financing? This is the investing section. Buying and selling non-current assets, property, plant, and equipment is investing. Now that's critical, folks. We've got to get in our mind what goes into each section. We just bought some furniture. That is an investing activity. Will that be an inflow or an outflow of cash? Outflow. Money's going out. I had to pay cash. So anytime cash is going out, that's going to be an outflow. Land began at $10,000, ended at $30,000. Let's stop right there. Land began at 10, ended at 30. What must have happened? I bought more land. Hold that thought. Mortgage payable began at 8, ended at 25. Mortgage payable increased during the period. What must have happened? I financed part of it by borrowing money, by issuing a mortgage. So I bought land, but part of it I financed by borrowing money through a mortgage. We bought land and issued a mortgage to pay for part of it. What we need to know is how much cash did we pay for land. Let's put together a journal entry. During the period, the land account went up by $20,000. What type of an account is land? It's an asset. More of it says it goes up. An asset goes up with a Debit, good. So you might jump to the area down below where you see the journal form and go in and pencil in your debit to land. Let's think about mortgage payable. During the period, mortgage payable did what? It went up by what, 17,000? Mortgage payable is what type of an account? It's a liability. More of it says it goes up. How do we make a liability go up? With a credit. So let's go down to my journal entry below. We already have a debit to land. Now we're going to have a credit to mortgage payable of 17. So we debited land because that asset went up. We credited mortgage payable to make that liability go up. Now it doesn't balance, does it? To make it balance, step 3 says plug cash. How much cash must I have paid for land? 3,000. That's the number I need. The whole reason I did this was to figure out the 3,000. Could you have done this without a journal entry? Maybe so. And if you don't want to do a journal entry, that's fine. What I want you to be able to do is to calculate the fact that we paid $3,000 cash to buy land. In what section will we record the fact that I have paid $3,000 cash to buy land? Investing. Buying and selling property, plant, and equipment goes in the investing section. Will that be an inflow or an outflow? It is an outflow. Outflows mean we're going to subtract. When cash goes out, we're going to subtract. In addition, this wasn't just a $3,000 transaction, was it? There's another $17,000 part of that. So the other part of this says that I bought $17,000 land by issuing a mortgage. Did that impact cash? No. Is it an investing activity? Well, yes, I bought land. Is it a financing activity? Well, yes, I issued a mortgage payable. This is one of those generally infrequent, non-cash investing and financing activities that we would disclose at the bottom of the statement of cash flows. So we would write a little list or a little sentence saying that $17,000 land was acquired by issuing a mortgage payable. It is investing because I bought land. It is financing because I issued a mortgage payable, but it didn't impact cash. The reason we disclose these at the bottom of the statement is, will it impact cash in the future? Well, yes, I have a mortgage, I have to pay it. And then maybe one day I'll sell that land and cash is going to come in. So it is going to impact my future cash flows, therefore I have to disclose it this time. It won't show up in the body of the statement itself, but would instead just be disclosed at the bottom. Barbosa's company. Equipment that cost me $19,000 and had $12,000 accumulated depreciation was sold at a gain of $6,000. In a nutshell, what happened? I sold some equipment. All right, I've sold equipment. What section will that go in? Operating, investing, and financing when I sell equipment. Investing, buying and selling property, plant, equipment goes in investing. Is this going to be an inflow or an outflow? An inflow, money's going to come in. But what we need to see is how much cash did I get for doing this? Now this is going to take us back to chapter 9, doing our mock journal entry. As a result of this transaction, my equipment account did what? Went up or went down? Went down. When you sell equipment, it's going to go down by what, $19,000? What type of an account is equipment? It's an asset. It's going down. How do you make an asset go down? With a credit. Good. Due to this transaction, what happened to my accumulated depreciation? It went down also, right? Because remember, when you sell the asset, you get the asset off its books for what it cost you. You also have to get its accumulated depreciation off the books. So accumulated depreciation went down, $12,000. What type of an account is accumulated depreciation? Contra-asset, very good. How do we make a contra-asset go down? With a debit. Good, because it's the opposite from an asset. Assets go down with a credit, contra-assets go down with a debit. So we have two pieces to our journal entry. Let's think about the third item that we need to pick up to talk about my gains and losses. Let's review that, taking us back to chapter 9. Losses are like my expenses. They are recorded with a debit or a credit. Debit, good. Expenses are a debit. Gains are like revenues. They are recorded with a credit. So losses are like expenses. They're recorded with a debit. Gains are like revenues. They're recorded with a credit. Now, in our example, what did we have? A gain or a loss? We had a gain. So here's what we know about my journal entry so far. I'm going to credit equipment, debit accumulated depreciation, and credit the gain. Now, if you would skip the first line, let's leave my first line blank here. And to make that journal entry balance, let's see, I've got two credits that add up to 25. I have one debit of 12. To make it balance, I'm going to need to debit cash for how much? $13,000. So to make it balance, I'm going to have to debit cash for $13,000. What do you think was the book value of that equipment? 7. Cost minus accumulated depreciation. I sold it for 13, which means I got more for it than the book value. Therefore, I had a gain. Now this is one that I think it really helps to do the mock journal entry. Now, again, you don't have to. Matter of fact, in just a minute, I'm going to show you how you can do it without it. And that's fine also, whatever works. The key is I want you to be able to tell me that I got $13,000 cash for selling that equipment. Where does that go in the statement of cash flows? I sold some equipment. Investing, inflow or outflow? Inflow, $13,000 inflow. So it's a positive number. We're going to add it. However, there's one more place this transaction is going to show up also, and that's going to be in my operating section. Remember my two things in the operating section. Changes in current assets and current liabilities, that doesn't affect us. But then we got the skinny girls items. So skinny girls, subtract gains, add depreciation expense, amortization expense, and the losses. What did we have in this example that needs to fall in that grade? Not good. I heard accumulated depreciation. That is not the answer, because whenever we add, it's depreciation expense, amortization expense, but not the accumulated. Where else so needs to show in the operating section? What part of it? The gain. Very good. Skinny girls, we're going to do what with that gain in the operating section? We're going to subtract that in the operating section. Why is that? Well, selling equipment does not provide any cash from operating activities. The gain made my net income go up, but it did not provide cash from operating activities. The cash that it provided came to me from then investing activities instead. So the actual cash I received from selling the asset goes in the investing section. We're going to subtract the gain in the operating section. Another way, if you didn't want to do the journal entry, that's okay with me. How could we figure it instead? Well, let's see. The equipment cost me how much? $19,000. And it had how much accumulated depreciation? 12, which means it had a book value then of 7. Now, if I sold it at a gain, what does that mean? Did I get more for it than the book value or less? I got more for it. So instead of just getting 7, I got 6 more. I got a total then of 13. And if you want to figure it that way, that's fine too. It does not matter to me how you come up with it, as long as you can tell me that you got $13,000 cash from selling equipment. Just to show you Walmart's, now that we've talked about a couple of these items, maybe it'll make a little bit more sense now. Payments for property and equipment. In other words, when they bought land, building, furniture, equipment, all these are negative numbers, which tells you what cash is going out. Here are their proceeds from disposing of property, plant, and equipment. When they sold land, building, furniture, equipment. Notice all of those are positive numbers, and they then have been added.